Hello, 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 and welcome everyone to session number one, Investing Basics from Beginner to Investor. It's great to have you all with us. If I can just ask a quick question, just type a yes in the chat. Ki Ming, great to have you with us. Haven't seen you in the chat for quite some time, but yes, just give me a quick yes in the chat room. If you can hear, you can see, fantastic. Amazing. Okay, phenomenal. Look, it's great to have you all with us. If you're watching on demand, welcome as well. This is session number one. If you could all let me know where you're logging in from as well. One of my favorite things about eToro is just seeing how many different parts of the world we have covered on these specific webinars. It's always great to see Portugal, Qatar, Germany, Athens, Slovakia, South Africa, Munich, Israel, Philippines. Amazing. Please do use the chat today to discuss. There's also a Q&A. We've got time for all of that and more. For those people that don't know, my name is Sam North. I'm an analyst in the UK. I'm co-host of the Digest and Invest podcast series. And I'm going to be your host along with our very special guest, Matty Alon, our editor-in-chief, who I'm about to pass you over to, who's going to share his screen. He's going to talk a little bit about the education we have to offer and digest and invest as well. Matty, how are you?
I'm okay, Sam. Excited. New quarter, new session. So it's really, really exciting, especially after the first one we did, which was a really big success. And yeah, it's fun. So before we start, we're going to speak about fascinating topic, especially, that's the beginner one. So we're going to try, to wrap up things in 4 sessions. Sam is going to do it amazingly. So you guys will get, as the way we call it, from beginner to investor. So from literally knowing anything to knowing something and be able to take it to the next level. So I just wanted to share with you something that we missed of doing last quarter, and we just actually launched that now. So I'm going to share with you my screen for 2 seconds, and then I'm going to leave it for Sam to start the course. So we just launched something we worked on for a long time. It's called Digest and Invest. It's free for you guys. What the Digest and Invest is
Matty,
a
it's
world...
not sharing at the moment.
It's not. Wait.
No.
So stop sharing.
Just quickly, just before, yes, this is live, and yes, it is available on demand. A couple of questions already before Matty shows us.
You can see it now?
No, not yet, actually.
It shows your screen. Someone can see my screen? Someone? Yes, we can. Yes, we can. Okay. Yes, you can. Yes, no, yes, no. Yeah, most of you, yes, one is no, one is yes, one is no. I have no idea. Okay, Sam, you're going to share it. Just share the Digest and Invest.
Okay. You can see?
Yeah, I can see for sure. So perfect. So in general, let me go quick because we're here to teach you investing. So the idea is that we created a world of video audio. The reason for video audio is if you like to watch it, you can watch it. If you want to listen that while you're driving or you're doing a gym, you can listen to that. We have 4 periods. It's 1, conversation with leader, where we interview CEOs of public companies, companies that you may invest in within our app, or different authors or financial authors or leading macro people like Nouriel Roubini and many other people. So you can come and learn and listen to their business from a bit different angle than just, what they did in the last quarter, but really understand the vision. We have the Market Bite and Trader Talk, which the Stock Break and Trader Talk, which one is doing fundamental analysis, 360 view for every time for different company. And the Trader Talks is where our genius technical analysis, Sam North, is doing weekly analysis for company. And then we have the Market Bites. Market Bites is my coolest thing because you have once a week Sam and Josh, our other analysts in Australia, wrapping up the 3 hottest topic of the week, financial topic, from all the angle 25 minutes on your way to work, on your gym, whenever you want it, Spotify, Apple Podcast, everywhere, you can enjoy it. All this free for you. We only ask you one thing: like, subscribe, and share if you like it. That's it, Sam. Back to you.
Absolutely. Yeah, it's always appreciated. I recognize actually a lot of names in the chat, which I know listen to the podcast already, which is great to have you all with us today. This is the second time running this course. We ran it in June, July, and we're going to do it quarterly. So feel free to come back as many times as you want. The recording you can watch also as many times as you want as well. There's 4 things that we really want to drill in on this session. The following 2, 3, and 4 is technical analysis, fundamental analysis, and then bring it together to build your portfolio. But today, what we really want to focus on is inflation and how it eats our money. That's the main thing we really want to drill in. And number 2 is that for people that choose to invest, there are indexes such as the S&P 500 or other ones that are similar that can beat inflation over the long term. And we'll look at the stats behind that as well. And then also number 3, the importance of compounding over time. And we've got a couple of analogies to discuss there as well. And then number 4 is diversification and how that can be important to use if you decide to invest actively. So look, what is investing? You've got a definition there. Investing is putting money into assets today in order to get more money in the future. In the chat, let me know things that you can invest in, and let me know who is currently investing and what kind of experience you all have. It'd be helpful just to see that there as well. Most people become investors at some point in their lives buying property. I'm sure many of you are thinking about that. Stocks or art. It is considered a good investment as long as the asset appreciates in value, i.e. the price paid is lower than the value of the asset you invest in. Moving on, why should you invest? This is back to our number 1 point here. Inflation is often referred to as the cancer of money because, like cancer, it eats away at the value of your currency over time. This can, in theory, lead to a decrease in people's standard of living, as they have to spend more money to purchase the same goods and services that they would before. Inflation can also create uncertainty and instability in the economy, making it difficult for businesses and individuals to plan for the future. So therefore, it's pretty important for governments and central banks to take measures to control inflation and prevent it from spiraling out of control, which maybe we've seen in the last few years. A great quote here from Warren Buffett, which I'm sure many of you have heard about. If not, get used to his name. He really is the GOAT investor of all time. You can see Matty literally has a toy doll of Warren Buffett. I don't quite know how I feel about that, but it's pretty cool, I think. The king. Someone sitting in the shade today because someone planted a tree a long time ago. Really good message there. It's important also at this point, I think, just to talk about investing education. Matty and I have worked very hard over the last sort of year to put together these courses and the podcast series that you have. And you're doing the right thing in coming on this course today. I have to say, it's great to have you all with us. And another great quote here: the best investment you can make is an investment in yourself. The more you learn, the more you earn. Now, the last course, Matty, we ended up having, I think it was about 15,000 people that joined us, which is incredible, really. And on your particular journey, we'll talk about your investing style later on. I mean, how important do you think it is to continue learning, to continue to develop, certainly for those people that are just starting out as well?
So basically, I've been, I think now, old 23, 24 years as an analyst. That's my profession. I managed a hedge fund, wrote about it a lot. I still learn. Literally still learning. It's never ending story because every company you read about, it's a new company. It's a new business model. It's a new, sometimes counting to understand the specific things. So we always constantly learning. But in addition to that, one of the thing in this course is that we split it to fundamental and also technical analysis and day trading. And for me, that was a new world. Although I knew the world, but I never like really, learned about it deeply until you and I built this course. And it was interesting and fascinating to learn about it, how you can even think about those things, making something to work with the fundamental analysis. So definitely learning, it's one of the most important thing, and this is why I invest so much in it, in eToro, through the academy, through the Digest and Invest, and through this course and advanced course that we were starting to do as well. So yeah, definitely. And if you guys always have a question or something, please approach Sam or me, because we're here to help you. Our goal is that when you make a decision, it may not be the best one, but it will be smarter one. It will be one that you will think about before you make it. Because at the end of the day, we are, as a personal, every person accountable to his own decision. And that's why it's important not to believe that, the world will correct himself or luck, but in investing, it has nothing to do about luck. It has to do about understanding. It has to do about processes. And I think one of the important things that in this course you will learn, doesn't matter if you're fundamental analysis or technical analysis, is to understand how those metrics are working, how they influence the volatility in the market, and how you can better understand how to manage your day-to-day investing.
Yeah, absolutely. Let me just drag this over here. It's great to have Matty with us, and like I said, we'll talk a little bit more about Matty's style of investing later on. He's got many years in the game, and is obviously going to be very beneficial for us. Inflation, then we talked about the importance of this and understanding it at the beginning, and you can see the Big Mac index. Has anyone heard of the Big Mac index? You can see there from 2008 to 2021 how the price has gone, but as an increase of 58.54%, whereas the average annual inflation is 3.56. It's worth us just talking about the different rates that we'll discuss those at a later time, though, as well. What moves the market? Again, these are things that we can discuss. The Federal Reserve, or the US central bank, for those people that haven't heard of it, has a variety of tools to control the money supply and influence interest rates in the United States. One of those tools is the federal funds rate, which is the interest rate that the banks charge each other for overnight loans. So by adjusting the federal funds rate, the Fed can influence other interest rates in the economy, such as mortgage rates and credit card rates. The Fed also has the ability to buy and sell government securities in the open market, which can inject or remove money from the economy. Additionally, the Fed could adjust the reserve requirements for banks, which determines how much money banks must keep in the reserve and how much they can lend out. Overall, the Federal Reserve has a range of tools at its disposal to help maintain economic stability and promote growth in the United States. And every central bank, that's really their main goal. And what you can see here, interest rates hikes can lead to lower economic growth, slower inflation, which brings that down. And on the flip side, as we cut interest rates, that can lead to higher economic growth and faster inflation there as well. The economic cycle is an important thing for us to consider. Many investors, it has to be said, are tempted to try and time the market perfectly. We've all been there, where you try and buy low and sell high absolutely perfectly to maximize the profits. However, attempting to do so is a pretty risky game that even some of the most experienced and seasoned investors can struggle with and actually often lose. So the stock market is influenced as well by countless unpredictable factors. If you think about them, you're thinking global events, economic data, company news, investor sentiment. So even some of these, best analysts and traders can't predict those with complete accuracy. And attempting to time the market based on guesses or hunches can really lead to quite costly mistakes. In the end, I would probably say it's better to have a longer term approach, have patience, focus on building a diversified portfolio of quality investments rather than trying to hit the jackpot with a single perfectly timed trade. So the point we really want to make here, Matty, is to be patient, have a long-term view, and try to cut out all of the noise, isn't it?
Yeah, definitely. I mean, think about it, and you and I discussed about it a lot. Unlike the movement in charts, which is daily, constantly, and moving fast because there are millions and millions of people trading, in economy there are cycles by the name of the cycle. Cycle is not a day cycle, is take time. And definitely I agree with you. I mean, patient is probably the key of successful investing, being successful in it, because any part of this cycle, it's something the world went through for so many times, and I don't think it's ever gonna end. I mean, we will gonna see inflation down, we will gonna see interest rate going down. When, we don't know, but that's just part of the cycle.
Yeah, absolutely. And then you can see that the main goal is keeping inflation under control. Now, question, and I will, of course, reveal the answer. What do you think over the last sort of 50 years, the average inflation rate is? Let me know in the chat. Give me a guess, and we will reveal all. And then also, what do you reckon the average stock market return is as well? We'll discuss that very, very shortly. Investing in stock markets as well, it means investing in businesses that are owned by people. And ultimately, by doing so, we're having a bet on humankind. We think we're going to develop. We think companies are going to develop. And that's quite a good bet to have. Every company on the stock market is driven by people, from the management team to the employees, suppliers, customers. These are the individuals who make decisions, develop products and services, provide support, and ultimately drive innovation. By investing in a company, you're placing faith in its ability of its people to execute their business plan and achieve their goals. Furthermore, the stock market is influenced by the collective actions and sentiment of investors, who are all humans making decisions based on their perceptions and belief about the economy, the markets, and individual companies. Therefore, when we invest in the stock market, you are not just betting on a company's success, but also on the potential of humankind to create and innovate, and the collective wisdom of investors to make sound investment decisions. Now, you may well wonder, well, does actually investing in the stock market beat inflation? On average, give or take, the inflation over that period I mentioned is about 3%. Whereas if you would invest in the S&P 500, the average return is close to 11%. Now, that's not saying every year you get 11% return, of course. In fact, the S&P 500 over the last 100 years, on average, finishes up 70% of the time. But I think it's quite useful for us to know that at least the stock market over time does beat inflation. And that's the point that we really want to drill home there. Again, so just why should you invest? Offset inflation's financial burden, improve your financial future, and prepare for retirement, and also create passive income. Here's just another example just on the investing education, how we can go about it. Learn the basics, grow our knowledge, understand our risk tolerance, and then be aware of those economic cycles should you want to be more active in the way that you actually do want to invest as well. Is the stock market profitable? Contrary to popular belief, you don't actually need to be a top analyst or financial expert to make money from long-term investing. In fact, people that have invested in the S&P 500, no one has ever lost money whilst holding for over 20 years. Now, obviously, that's a long time, but it's really about having a long-term process, long-term outlook, and patience that can really, really help. Now, of course, while having a deep understanding of finance and the markets can be beneficial, it's not necessarily a requirement for success. The most important factor in achieving long-term success is having a solid investment plan and then sticking to it. So that means identifying your financial goals, determining your risk tolerance, and develop a diversified portfolio that really does align with your objectives. However, it is important to keep educating ourselves as well. Some stats for you. We mentioned the S&P 500. The MSCI World Index had an average annual return of about 7.9%. The FTSE 100, that's an average of 7.6. The Hang Seng 9.4. And from 1971 in its inception, the Nasdaq to April 2023 is 10.8%. So again, it is good to know that we've got the stats really to back this up, and that's something that I want us to keep drilling in there as well. So inflation on average 3%, stock market around 11%. Usually 70% of the time the stock market finishes up. Key to know, history is on our side. Different asset classes that you can invest in. I saw a lot of really interesting answers in the chat when I asked you what you can invest in. And here are some of the different asset classes that you can go through. Let me know what you already invest in. Let me know what you favor as well. Stocks. So these are obviously shares of ownership in a public company. Each share has a value based on the company's total worth divided by the total number of available shares. If you think of companies like Apple, Amazon, Nike, these kind of companies, public companies that you can invest in. Price can move on earnings and the macro environment. Value is based on quantitative and qualitative analysis. Investors are shareholders, part owners in the company. You can also invest in commodities, the building blocks of the global economy, used to create products we rely on every day. Examples: oil, gold, copper, sugar, silver, platinum, you name it. And there's a lot of commodities out there that I'm sure you can also view on eToro. You've got if you have an account, there's the demo account as well, where you can practice and try things out and discover all of these different markets and assets. Things that can move commodities, the price of the US dollar. A lot of commodities are priced in dollars. Seasonality, supply and demand, and obviously headlines, news headlines as well. Geopolitics, for example, can all move the price of commodities in the short and long term. Currency investing, or FX or Forex, foreign exchange. I'm sure you've heard of those words before if you've started trading or investing. Is the process of buying and selling currencies against another. You've also got bonds and fixed income. A bond is a debt security used to raise money for a government or corporation or municipality. Struggling with that word a little bit. A lot of them are considered safe haven assets, certainly in the US. Easy to predict recurring income. Invest in public companies with less risk. Treasuries, government-backed securities, and in general, they're less volatile. This year, or the last couple of years, Matty, we've seen bonds do quite well and becoming more and more popular. We're seeing on the platform. Crypto, how many of you invest in crypto? Let me know in the chat. The fast and growing investment of the 21st century. Crypto's transformative technology is changing the world as we know it today. However, things for us to consider: it is more risky, mostly speculative, more volatile, but that doesn't necessarily mean it's a bad thing. Remember, supply and demand, main thesis, it's 24/7 trading. No rest for the wicked. With the stock market, we at least get the weekend to relax. Not with crypto. Highly volatile, more for sort of short-term trading as well. It's key to watch the institutional adoption, whether that starts to pick up and whether therefore people look to invest in it. Indices, a stock index measures the performance of a particular group of stocks over time. So we mentioned the S&P 500. For those of you that don't know, the 500 largest US companies. So if you think of some of those companies, your Netflix, your S&P, Nvidia, Amazon, ExxonMobil, Chevron, these kind of companies. And it's the most invested stock market in the world. Okay. The Nasdaq 100, top 100 largest US technology companies. The FTSE, for those that are in the UK, the 100 largest UK companies, and another example, the CAC 40, the 40 largest French companies in France. ETFs, these are exchange traded funds which generally track a bundle of assets from a specific index. So you might have an ETF that tracks the S&P 500 or an ETF that tracks the FTSE 100 as well. These are quite useful as they're generally quite low cost and low fees. They're highly liquid. You don't necessarily need a high or load of knowledge to invest in them, and great for diversification as well. So these are just different types of assets that you can invest in. Now, as we'll go through on the course, a diversified portfolio may include more of one than another. Some may be considered more risky, some more safe, and that's something to consider. Different investing strategies. You've got value investing. Here you're looking for a bargain in the market. You think something might be undervalued and you think over time it's going to appreciate. Growth investing, looking for potential. Is there an area in the market that you think's really got potential to drive on? Let's rewind 2 years. You may think AI is going to really pick up. What stocks are related to AI? Obviously, Nvidia has had a phenomenal last 2 years, and we've seen AI at the beginning of this year do really, really well. Momentum investing, you're riding the wave. Income investing, generating reliable passive income. Generally speaking, those that are maybe more risk averse or closer to retirement look to go down this route. Index investing, keeping it simple. Investing, maybe it be every quarter or every month into a selection of indexes, and therefore people dollar cost average, buy and hold. And then you've also got passive and active investing. Now, Matty, I mentioned we talk about your investing style, and you come under the value investor part of these investing strategies. So can you tell us a little bit about that, why you do it, and why you think it's a good strategy people might consider going down?
Well, yeah, basically, I mean, the whole idea behind value investing is, if we take the stock market out for a second, it's just buying a company, right? And when you invest or buy a company, basically what you expect from this company is to generate cash over the long term on this company. And those cash that the company is projected to make, that's the valuation you want to pay on that. So if I'll tell you that you can buy a business now and this business will make you $100 in the next 10 years, and I will tell you I'll sell you this business for $2,000, you will tell me, are you insane? I'm not going to make this low return. But if I'll sell it for you for $100, you would say, wow, I'm going to make 100% on this business. So that's what I like about value investing, is that at the end of the day, you want to understand the fundamental value of the business. Now, if we look at the long term, and this is, I think, what value investors believe in, and Benjamin Graham and Warren Buffett spoke about it not once, is that over the long term, the stock market appreciate or depreciate the share of a company based on its intrinsic value. So if the company, what it means, to make it simple, if the company is going to make cash as you expected and grow those cash, so it's more likely that the share price is going to go up with this earning, and vice versa. So that's why I like value investing from this perspective. And last thing, it gets you better to understand the company you invest in, right? I mean, a lot of us, and reading through the question here, someone I think just said that, I don't know what to do. I was losing a lot of money in the last market volatility. I don't think it means anything what's the last market doing, what's the next year market doing, or what 2020 market did. As long as we hold for a second, stop what we're doing because we don't understand, learn a bit, I mean, that's what gives us the understanding of what we're doing and how to deal with things. Because almost for fact, there is no reason why a person cannot succeed in the stock market. It's just the behavior, the way it does it. Yeah. And to finish with, think about it this way. Let's say you go now and you go to buy a car. I mean, if you go and check the car, secondhand car, and you check the car and you do the inspection and you check everything, the likelihood of you doing mistake and losing money aside from depreciation is very, very small. But if you will go and buy a car without doing the check and everything, maybe it did like a big crash or something, and the whole valuation is half of that. There is no difference between the stock market and buying a car, buying a house, buying any type of investment. If you check it, your risk is going down. If you don't check it, your risk is going up. And obviously, we always want to pay cheap. So
I love
that's
that.
the rule.
I
Like in
love
real
it.
estate, in real estate, there is location, location, location. In stock market, there is price, price, price. So,
I absolutely love that. And of course, you've got to know what to check for. And that's why we're putting this course on.
yeah.
We've got the course on the technical analysis of those people that want to bring in price discovery into their investing. We'll talk about that. For those people that want to look into the fundamentals, we've got a course on that. And those people that just want to know how to build a portfolio, put everything together, you bet it. We got a course on that as well. So 2 different analysis methods, 2 broad categories: fundamental analysis, company analysis, industry analysis, economic conditions, and future profit outlook, things for that we can consider, and then technical analysis as well. Fundamental analysis, just to go into a little bit more detail ahead of the future course that we got, it helps you. Fundamental analysis utilizes all available data that we have to determine an asset's intrinsic value. Investors will look for assets that they believe are under or overvalued in comparison with their analysis to form their investing decisions. And this type of strategy requires long-term investment of capital. We'll go through all of this in a lot more detail. We'll start looking at balance sheets, income statement, cash flow statement, and how we can use this information to make more informed decisions, comparing it to last quarter, to the quarters before that, comparing it to companies that are similar. So if I was to look at, say, Tesla, I want to look at other electric vehicle companies. How did they perform? And then you can start making more informed decisions through that. Technical analysis. This is course number 2, session number 2. Stay tuned to the end of the session. I'll provide you all the link if you haven't already got it. It looks at statistical trends gathered from trading activity, such as price movement and volume, to evaluate investments and identify potential trading opportunities. No weight is given to a company's activities or fundamental value. The main focus is price and volume, but we'll talk about how people that do that successfully look at the market and also what to avoid as well. Typically, this strategy is used more for short-term gains, but people will absolutely combine both of those as well. Next up, and you probably all recognize this man as well. If you don't know Warren Buffett, I think we can forgive you, especially if you're completely new to the world of investing. I don't think there'll be too many people that don't recognize our chap on the right-hand side, Albert Einstein. Now, I have to say, I'm not 100% sure this quote is true, but I like to believe it is. He went and said, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. So compound interest essentially is profit earned on your investments that are reinvested, earning you more profit. So keep it very, very simple. Let's just say you've got £100 and you make 10% of it. Obviously, that would now be £110. If you make 10% of 110, that's obviously going to be more, and it keeps going like a snowball effect as well. So really, really useful. Last time we did this, Matty got very excited about this magic table. It's one of his most favorite tables that there is out there. So I'm going to pass it over to him, but it really, really is. If you are to take one thing from this session or to screenshot and print it off, one slide, it probably is this one, isn't it, Matty?
Yeah, for sure. I mean, I'll share something with everybody. That's like my Hall of Fame. So what you can see here is Mr. Buffett and me, but this is more important. the literally magic table is always behind me. Why it's behind me? Because as you can see in this table, at the end of the day, we make money over the long term. And the magic table show us something that we, as when I was a young person, and lots of you guys are young people, it's hard for us to think in 10 years, 20 years, 30 years. But believe me, I mean, and maybe you heard it so many times, time goes by very, very fast. And time and the percent that you're able to make are the most important thing in order to make a really, really big sum of money. And the magic table, basically what it shows you, as simple as you can see, over 10 years, if you will make 5%, what will happen to $100,000 investment is 162. Just to give you explanation, if you would not do it compounding, and the idea of compounding is just investing in it, and the money you invest make money on the interest, it would be 150,000. Now, if you look at 30 years at 20% or 15%, you're talking about millions of dollars. And there is one saying that you always hear them. And one person that invested, I don't know, what was it, like $10,000 at Berkshire Hathaway, at Warren Buffett company in 59 or something like that, until today, now it would have like $1.6 million. The reason for the $1.6 million obviously is because Buffett generated about 19% IRR, okay, but he did it for 55 years. Yep. So this is the beauty of compounding, and we always need to remember is what we make in the long term, and as much patience as we have. And this is why I like this table all the time, to make sure that I'm as close as I can to the 20%. And as for the years, I don't touch my investment as long as I don't need the money for living or something like that.
Yeah, absolutely. And also, let's just rewind, right? We know historically, if you were just to invest in the S&P 500, right, you're getting that above 10%, which is, incredible to see what can happen there. And it's quite interesting, just talking about compound interest, and it's a crime that it's not talked about in schools and stuff like that. But whenever I explain it to my friends, they're like, what can you, just run that by me again? Like, is that true? The numbers behind it really is incredible. But it goes back to our point about being patient, having, a long-term outlook as well. It really is super, super important. Investing psychology. Look, we're going to discuss this in a lot more details as we go through. And behavioral finance is the study of the effects of psychology on investors and financial markets. This is a great saying. This is an all-time favorite of mine as well. Markets can remain irrational longer than you can remain solvent. Different biases. You've got self-attribution bias, confirmation bias. I'm sure we've all sort of kind of resonated with that, where you try to convince yourself, oh, this is the right idea, so I'm going to do it. Representative bias, framing bias, anchoring bias, and loss aversion as well. To some useful ones there. Loss aversion, for those that don't know, trying to avoid a loss more than sort of recognizing investment gains, so that desirable investment or finance opportunities that are then missed. But it is important for us to sort of understand this. What kind of investor are we? And that's really why we're taking you on this journey. The idea is that you get to that session number 4 and you say, okay, well, I'm more suited to doing this or less suited to doing that. So hopefully you'll realize that over the coming time, as well as understanding your risk appetite as well. The degree of price volatility a person is ready to accept in their portfolio is known as their risk appetite. However, Warren Buffett, again, risk comes from not knowing what you're doing. Don't feel like you need to, you ever need to force this journey. It is a marathon, not a sprint. You've got the demo account. You've got all of this free education that we're providing. Okay, there's a lot of stuff, great stuff out there. That means you can take your time and you're in the right hands. The amount invested in assets that can move higher or lower in price the amount you are willing to lose on a single asset. These are things that are worth considering before you get in. Longer timelines are generally more favorable for taking on more risk. As I said, no one has ever lost money in investing in the S&P 500 over a 20-year period. On a day-to-day basis, 53% make money, 47 lose if you were to hold for 24 hours. The longer you go, guess what happens to that probability? It just goes up and up and up and up. More knowledge reduces risk and permanent losses. It's like Matty's example about buying a second-hand car. If I was to go and buy a second-hand car now, chances are I'm probably going to lose money because I have absolutely no idea about it. But if I take my time, do my research, speak to people with more experience than I do, then I'm going to make more informed decisions as well. Diversification, probably the most said word at eToro over the last few years. And I would argue rightly so, but I'd also argue a lot of people that hear it don't really understand exactly what it is. So, definition time. A common risk management strategy whereby an investor holds multiple assets from a range of different asset classes, industries, geographic areas in order to broaden their exposure and hopefully bring down that risk, as mentioned. So we've got 5 different portfolio examples here. We're going to go into way more detail, session number 4, but you've got one on the left, which is more conservative, and you've got moderate, balanced growth, and 2 different growth ones there. The conservative one, if you think about, well, answer in the chat, who's more likely, what sort of person is more likely to be more conservative? Remember what we said, fixed income, generally more of a safe haven asset. Returns are going to be slightly less, but also the risk is slightly less. What type of person do you think is more likely to invest that way? And then on the flip side, the other end of the spectrum, you've got people that are more looking to invest in stocks, growth stocks, less on the fixed income side, maybe more crypto as well. So yeah, absolutely. Those that are closer to retirement at the end of their investment journey, people that don't want to take too much of a risk are more likely to be conservative, whereas those at the beginning of their investment journey are potentially more happy to take on more of a risk because they've got long time to go with it as well. Matty, anything you would add there just on the diversification? It is important, isn't it, for people to understand?
Yeah, so I mean, diversification is, in my opinion, split into 2. First, the goals that you have, right? As you mentioned that, because if you're looking to do something for I don't know, saving or anything like that, you're probably gonna put something that is like, it's not too risky, it's sort of income paying and stuff like that, which is also relative to your age. So if you're an older person, so you don't want to risk your money. And when I'm saying risk, let's say, for example, you hold the S&P 500. So you hold basically 500 of the largest companies in the US. I'm not talking about risk that your money is going to go to zero because we need 500 companies to go to zero. However, when I'm saying risk, and that's something that not many people understand, is the risk of you need the money in a bad times. And if we'll take 2008, so the S&P 500 went down 56%, right? It's mind blowing. You're like, what do you mean? 500 largest company in the US are down 56%. Yes, they are. Obviously, they corrected and they're in a big profit since then. But just assume that you needed the money at the same time. I mean, you would have to sell at a big loss. That's why when we say diversification, you need to diversify in order to understand that the market is not predictable. Over the long term, we know that the market showed us 100 years of continuing approaching new highs. And if I need to bet, I will bet that the S&P 500 as a whole will continue to approach a new high. However, because we don't know what's going on in the short term, we want to make sure that we're not forced sellers when the market is down. So that's the first one. And the second one is just from perspective of not understanding. Okay, Buffett said that Buffett is really one-siding the investing in the S&P 500, because his point of view is you get 500 companies, well diversified. It's a big amount of companies from a diversified also industries, our regions exposure and everything to do with that. And the reason for that is that if you don't have the capability to do a deep analysis for a specific company, it doesn't make sense that you will hold 5 companies, right? Yeah, you may say it's diversification because I have 5 companies, but you may really you may gonna make capital loss because you don't understand what you're investing in. So that's why when we say diversification, it's keeping you in a way safe in order when you do mistake. And by the way, we all do mistake. Even Warren Buffett and Sam and I discussed on that so many times, which by the way, Sam will teach you in the next courses about how important it is to acknowledge that you need to lose money in order to make money. But this is the second part, and especially, and I saw so many comments here while Sam, you spoke about, losing money and how should I do it and how should I not do it. If you're beginner and you don't know what you're doing, my best advice will be wait. First, understand, learn, get knowledge.
Yep.
But my second thing will be try to diversify it as much as you can and on a different asset, not just the world of 5 companies, 10 companies, 20 companies, but try to be diversified because you reduce the effect of every position. So that's why it's important. But again, I'm pretty sure that after this 4th session, you're going to get a bit more understanding of how to do it. But it's extremely important, the word of diversification.
Yeah. 100%. I mean, look, when it comes to sort of choosing an investment strategy, there's some questions that we can ask ourselves as well. I would say before we ask those questions, it's important for us to consider factors such as your financial goals that you have. You need to understand that, your risk tolerance, how much risk are you happy to take? I mentioned people closer to retirement. You don't want to take too much risk that you could lose 20% in a year, for example. Right? That's not something that you'd be willing to do. So therefore you go down the route of investing in assets that are less likely to do that. Obviously, we need to work out your investing time horizon, the amount of knowledge that you have as well, and experience that you have with investing. The questions I think are great to start are, do I have an emergency fund? Okay. Because last thing you want to do is invest money and then two weeks down the line be like, oh, I need that. Have I got, money for a rainy day, whether that be to fix a broken car or sort a roof out if it goes wrong. Okay, that's your sort of pot that you need, and you can leave that there, and you have that, then you can start investing. Fantastic. Am I committed? Another question: am I committed to leaving this money in place for 2 to 5 years and longer? You've seen what happens with compounding when you go 10, 20, 30 years. Fantastic. But can I be committed to leaving this money in? And also, can I weather the ups and downs in the markets? Because there's going to be some. If I told you all now to name, 2 of the biggest companies in the world, a lot of you are going to shout at me, Amazon and Apple. Both have had periods where they've dropped 50% in the last 2 decades of their share price.
Even more, by the way.
Exactly. Yeah, 90% in the early part of the millennium,
Netflix,
right?
by the way, Netflix, not many people know that, okay? Netflix drawdown in 2014, we're not talking 20 years back, 2014 was 90%. Just when they changed the model from like the really, sending the DVDs to home and changing it to no one believed it's going to work. 90%. Look at the chart, 2014.
Wow.
And, and everybody is like, yeah, if you would own in Netflix, you would make thousands %, etc. And I said, yeah, but you need to go through, big drawdowns in order to be that successful. And I just wanted to say something because I saw a point that jumped to my eyes, and I'm sorry to cut you, Sam, from Joseph Tiscala. I'm sorry if I didn't say your name right, but I'm going to read what he said. I agree with the diversification, but in reality, the way how Warren Buffett earned his billion were a few successful bets where he bet 20% or more of his net worth to a single company. I agree with you and disagree with you, and I'll explain why. Because to achieve what Warren Buffett achieved, 20%, you need two things. First, to have Warren Buffett capabilities, and second, maybe to be as much concentrated as you can be. However, we need to remember that almost 90 or 19 something percent of managers are not beating the market, and the market S&P 500 knows how to generate between 8 to 11%. Again, it can be the average of 9% or whatever. So for fact, you know that you can do at least half of Warren Buffett is doing without being an active, without holding 3 or 4 or 5 companies, with holding 500 companies. Obviously, we don't know what's going to be in the future, but this is just the fact. And what Sam just showed you in the compounding table, if you can go back, Sam, just for a second to the compounding table, that people can understand what's the effect of literally, I think you went through that, here. So you can see what happened in the 10% for 30 years. You could still be a millionaire after 30 years investing and gaining 10%, which is sort of the S&P 500. So I agree with you. In order to make the returns that Buffett did is not just a very small amount of shares, but it also understand what you're doing. And I think that was Warren Buffett's point for many, many years. But you can still make money in the stock market without being Buffett, without being investing 20% in one company, which not all of us have the knowledge for that. Sorry for cutting.
No, I'm very happy you did, and also a great question, by the way. And on diversification, we're going to cover it in more detail as we go through the course, and certainly on building your portfolio. As I mentioned, that's the 4th session that we will discuss there. Just before we do the summary, I'm recording a video either tomorrow or Friday. As Matty said, we do. I do a weekly video called on Trader Talks, where I'll look at a specific market or asset and then discuss it from a technical point of view. That decision is down to you. Everyone name a stock or a market that they want me to do, and the one that I see the most times is what I'm going to do, as long as it's not Tesla, because I've already done that. So let me know in the chat. While you do that, and while I have a quick look, let's just go through the summary, and then we got time for questions, as we promised. The first thing is, look, investing works. We've got history on our side. Now, that's not me saying that, by the way, next year you're going to get 10%. But over time, history's on our side. 70% of the time, the S&P 500 finishes up with an average of between 10 and 11%. It beats inflation, which we know historically is about 2.87%, I think. Important for us to understand what we are investing in. Decide those different asset classes that you want to invest in as well, which maybe suit your personality more, your risk appetite as well. Let's then work on understanding factors that can influence our investment. Let's work on our investing style, which we're going to focus more over the course of the next sessions. Think about compounding and the importance of that. 8th wonder of the world. It's not a lie. Diversification as well can be useful for risk management. Let's just have a quick look in the chat. What was the most said stock? What really sticks out to me? A couple of Nvidia's, gold said there as well. BYD. Okay, interesting. Oil, Rivian. Right, I'm gonna have to look at this at the end. There's quite a lot that I want us to look at. Right, time for questions. So we'll have a look in the Q&A. Just before we do that, and just before Matty and I have a quick look, I'm just going to share with you a couple of links via QR codes. So for those people that did want to sign up for the second course, I've got a link. Just bear with me one sec. Actually, Matty, while I just find that, is there any questions in the Q&A that you wanted to answer?
Yeah. So first, I saw so many questions, and I shared almost 10 times the link for the recording. So I'm going to do one again. I guess not everybody was listening. I just shared the link to the recording. We have a page there for the whole 4 sessions. So every time we will finish a session, basically you can just go on this session and use it and enjoy it. in addition to that, I saw many names here, and it's fascinating to see actually a big diversification of names. But yeah, the only thing if you can take with you from this session, which was a really basic, try to level up with everybody, wait for the next session and session after that, because those sessions are going to be a bit more deep dive, so you will have some tools to understand more things about the companies. For example, I think I see here ASML. So in Digest and Invest, we did a stock breakdown on ASML.
Yep.
Literally did 360 view on the company. So in 25 minutes, you can get from our analyst much better understanding on this company if you don't understand it. I think, Sam, you're just sharing the QR code for the Digest and Invest and session, or you can go to our YouTube and see literally how our analysts doing the presentation for those companies. I saw some of the companies that we did analysis on them. So if you want to gain some understanding, but again, guys, just be patient a bit. We know you're beginners. That's why we build this course. A bit more patient, 4 sessions, and you will probably understand better at least where to get sources, where, some basics about how to look at valuation, understanding those things. What's the risks? Risk. When you invest, you have risks and some psychology. Yes, Sam, so that's on my side.
Fantastic. Yeah. And as Matty said, the QR code for Digest and Invest is on the screen along with session 2. You can just do that with your phone and sign up, and then it will remind you ahead of time. But every session is on a Wednesday at the same time, depending where you are. Actually, I suppose if anyone's in Australia, it's already Thursday, isn't it? For any questions that follow, feel free to send us a message. Twitter's always useful. I post regular market commentary on there, links to the podcast. Same with Matty, and both the QR codes are on there as well. I see a few questions in the chat. Is this recorded? Yes, as Matty said, it absolutely is, as is every other session. If for whatever reason you can't attend live, the same link you sign up with, you can watch whenever you want. And even in 1 month's time, the same link will work. And like I said at the beginning of the session, I recognized a lot of familiar names that have come back from 3 months ago. So it's great to have you all with us again. And why not? Why not keep coming back for a refresh? Keep developing. And the best thing, as I always say about eToro, is the community and people interacting with each other, answering each other's questions. It's always great there as well. Matty, unless there's anything from you.
There is only one thing, because I saw a few people asking about CFD. I'm gonna share now in the chat some article we put together about CFD. Let me just do copy paste and share it with you, because it's really important for us as a company that you guys will understand how CFD work. In addition to that, we're working on a very detailed course about CFD, so you can understand the pros and cons of that. So I just shared that in the chat. Please take the time to read it and understand it. It's very valuable and important for you to understand this tool as you use it when you're a eToro client.
Yeah, absolutely. Look, we'll wrap it there. If you're watching on demand as well, hope you enjoyed it. Hopefully we see you all next week.
And wait, there is one more thing. I totally forgot. Tomorrow,
is this the most important thing?
It is the most important thing. Tomorrow we're gonna go out with our quarterly outlook. So for everybody, if you're interested in seeing what our top analysts thinking about where the market is going, where are we, believe more or less, what type of assets we believe in, what regions, what we have in thinking for the 4th quarter, we will send tomorrow an email to all of you. So check your box to make sure that you will get this email or notification. It's a 30 minutes interview that Sam, our analyst, is doing with our top analyst from US, UK, and from Australia. So you will get a really nice snapshot of our thinking for going further. If you will have question after that, first you can drop it in the link on YouTube, where we will share tomorrow the email, or you can ask next week when we have another session.
Yeah, absolutely. I'm just sharing the YouTube page as well if anyone's on
Yeah.
YouTube and wants to subscribe or whatever.
Yeah,
But it'll be
you
up here
will see
tomorrow.
it tomorrow. Tomorrow
Yeah.
afternoon at the UK time, it's going to be available to everybody. But yeah, it's exciting. We already recorded, and I can tell you, you're going to have a lot of interesting things there, because we share our exclusive retail investor data to see what investor are in the retail world are doing. And by the way, I can tell you something: the retail investor beating the professional investor this year big time, especially the hedge fund manager, which were thinking so many different things. So really fascinating.
Yeah. Looking forward to seeing that back, and also seeing everyone next week. Thank you very much for joining. I hope you enjoyed it. I hope you found it useful. This is the first step on our journey together, the building blocks for hopefully success down the line. Thank you very much. And Matty as well, thank you very much for joining too.
Thanks, Sam. Thank you so much. Looking forward to see you next week.
Take care, guys. Have a good rest of your Wednesday and a good rest of your week.
Bye-bye.